So that leads to you gentlemen. Can you give us some examples of things that went awry in the syndication involvement with taking down a multifamily acquisition that you guys maybe were part of or heard afterwards, and maybe a pro, like you're a good thing and a very bad thing? I mean, there's usually not something in between.
So I have a personal experience. On the first syndication I ever did was a smaller 30-unit complex in Northeast Philly. It was a syndication. It was a 506C. Mostly family and friends money, right? So I'm acting as the steward of my investors' money, but also it's family and friends, so closely involved. People have to see every day, so you can imagine the risk and the emotion, the tension there when a deal goes awry. It's someone I have to see on a regular basis, right? So you're paying more attention. But what had happened, the story, what had happened, we bought this transaction, we did our due diligence, first transaction ever. We did all of our due diligence. They have a central boiler system in this 30-unit complex. So one boiler that serviced the heat for 30 units. So big boiler, expensive boiler. We did our due diligence, checked out, we thought it checked out fine. Turned out, probably 120 days into the transaction, everything was going fine with our sort of rent projections and renovations. The boiler starts to go. We're talking about a $40,000 boiler. When you do when we do the syndication, right, you're raising money from investors. So that equity is coming from investors. It is a daunting thing that runs through your mind when you've got a $40,000 potential expense and you have to now turn around and go to 20 different investors and say, I need X amount from all these investors to be able to replace the boiler, something you missed during your due diligence. So there's two problems there. One, you look poor as a sponsor, right? You miss something pretty substantial. And two, you have to go back to investors and hope that you can even get the money from all of your investors to be able to replace the boiler, a critical component to operating the property, right? Just literally operating the property. Turned out we were able to sort of do a repair that was a short-lived repair, but we had a short-term hold on the deal, so we got out. Everybody made great money on the transaction, but it was an experience that really taught me a lot. I think a lot of operators, syndicators, really need to keep it back in your head. Due diligence, underwriting, super important. Going into a transaction, understanding that it's not you that's writing a check. I mean, it may have to be you that's writing a check. When you have a deficit in cash flow or a shortfall or a missed expense and a capital repair that you can account for, but you have other investors, right? That's where your equity came from. So one of the biggest things I could probably say is spend a lot of time during underwriting, spend a lot of time during due diligence, create a capital reserves budget, create an operating reserves budget, raise that money up front, allocate that money up front, let it sit in an account. Ultimately impacts your overall returns on the transaction because it's sort of dead money sitting there, but it's something you have to account for because you don't know what's going to happen, 3, 6, 12 months down the line, and you don't have the equity to be able to repair or make a major replacement. Or God forbid something happens like COVID again where everybody's short on rent and you need to pay your mortgage and your taxes and your water bill. You need to be able to have that reserve money. So I think from a syndicating perspective, that's one of the riskiest things I think from an operator needs to think about, making sure you have the capital and have the cash.
I would say the underwriting in and of itself is which you touched on, is important. And if I think brokers will actually test you sometimes if you do get into a competitive situation like that 110 unit deal. The brokers will test you and ask you how you're underwriting certain things, and if you give them an answer that is just screams that you don't know, then you could lose the deal, not even get to the point of owning it and doing the syndication. So the underwriting is super important from that perspective.
That too, yeah.
That just ties back to why the SEC regulations are what they are. So when you sit with me as the attorney to go through that PPM, we're going to go through those risk disclaimers. Because what it does is it makes you think about all the things that you may have missed on the property. There's a section in the disclaimer about environmental hazards. Did you get an ESA study, a phase 1 or a phase 2, right? So it's designed, and the SEC purposefully did it that way because you are the steward of your investors' money. You're the fiduciary is what it's called, right? You have responsibilities with these people's money that you've taken. So they want to make sure that you have done your homework, that you have done your due diligence, right? That's why the SEC makes you disclaim all the facts about that project in that PPM. So we're just kind of tying that full circle about why that's so important, right?
Well, I want to throw something at you before we open up to some questions, and it's back to you or not. In my experience in lending, one of the GPs or the GP needs to be technically the gray hair guy.
Yeah.
Okay, because at the end of the day, if they're not a past operator and they're looking to leverage a $3 million multifamily, they don't have the portfolio or experience background to support it, they have to bring somebody in as a GP with them and split that. How does that happen in your experience? How does that work itself out a little bit?
Yeah, absolutely.
By bringing that individual in when it's necessary, because eventually just because we're older, we might not be the gray hair guy. Let's elaborate what the gray hair guy is. Somebody that's approvable for that loan, based on the size and the dynamics of the project itself. I got to get comfortable with that guarantor or the person that's going to be in the GP spot, that they understand how to operate this, what they're trying to acquire. So
And before you answer that, Nan, you also from a operator side, you often need that, call it gray hair or key principal, to also fund some of your diligence costs throughout the process, right? Because you haven't even closed the transaction, you haven't even raised the money yet. You might spend $20,000, $30,000 worth of diligence on inspections and appraisal reports. You might post some money for your financing to rate lock. You might have to post a pretty sizable, particularly in this market, a sizable deposit. You might have to post a second deposit.
Hard?
Yeah, hard money at that, non-refundable money at that.
Hard money, that's fine.
So when you syndicate and a lot of your equity to do the transaction is coming from other investors, you need to think about sort of before you even close a transaction, where's that money coming from? And oftentimes partnering or aligning yourself with somebody, as Joe calls the gray hair guy, or somebody with the capital helps facilitate that. helps facilitate that and even get you to the place where you can even close.
Plus the upfront legal fees.
Yeah, right.
Well, we waive upfront fees in certain cases, but yeah, generally, yeah, right. You're absolutely right. We call it a key person, right? So you need most lenders, because when it comes to lender, they want to protect the money that they're about to give you. They're about to give you $3 million, $10 million. They want to make sure you're not just somebody off the street who's never done something like this before, never handled that kind of money before.
and just because they
Right.
raised the money doesn't mean that
exactly.
supports the idea that you can
Right.
get that loan.
So key principles are a part of every single deal we've ever seen on syndications. It doesn't really matter what the size is, right? I mean, the caliber of the key person might depend on the level of the deal and what the lender requires, but almost in every single one of these deals, you're going to need somebody who's going to be able to back up your sort of comfortable position with respect to the lender. And oftentimes, just as an aside on this, is purely a practical matter. If a key person is not part of your actual GP team, right? Let's say it's you and your buddies, or you and your core business partners that are the people who are doing the syndication, so that's your GP team. And if you don't have a key person amongst you, what we typically see is we will bring in a key person for this project and make them part of your GP team. And oftentimes that key person will probably charge you a fee, by the way. They'll be like, okay, well, I want like a 1% loan guarantee fee or something, or I want this, or I want that. And that's fairly common, and that's negotiable, right? And that's one of those things you work with, and oftentimes can be paid on the backside of the economics that says, hey, when we sell the deal, that's when you'll get your percent, or whatever it is. But oftentimes there are economics involved in that as well, right?
So I can give you an example. I was working on not a big deal, it was a 34, 35 unit property in the Virginia market. Gentleman raised the money, got the money raised, put it all together, he's all excited. The bank turns around and says, you have zero experience to take this deal down. He had to scurry around, beg, borrow, and steal, and at the end of the day, if this guy walked away with 10% return as a GP in his own deal, he was probably lucky. But at the end of the day, he learned, and he got himself in the green room. I'm using some terms that we use on the lending side. He now took a deal down. Okay, so he has that as a tombstone. So sometimes you got to give up a little bit more to get that first deal done correctly and recognized. Where a lender like myself will pick that up as part of your resume, because when I put together a scope of your background, I'm presenting that to a credit committee. Okay, I'm discussing about you to 30 other peers in my team, and we're ripping it apart. And when we dump these numbers and this information into the spreadsheet, there's certain things that go red. And those red items are the ones that are working against you. So in a situation when you're trying to raise syndication funds, if you don't have that lending experience, make sure you size up somebody that's not going to be willing to take literally the whole welcome mat out of you on the deal. You got to negotiate that out more up front. Okay, I had to bring a gray hair guy in for this young gentleman. He got the deal done, but that guy literally took him over the coals. Okay, so I want to open it up to some questions now because we try to stay within 60 minutes of. Was it my expression's funny? I come up with some creative words. It's very North Jersey stuff. But you learn it. Let me tell you something. When I started off in lending 20 years ago, I'm on a conference call and they're talking about skin in the deal, and I'm like, skin? What the hell am I talking about skin? Who's giving their skin to the deal? Like physical skin? So I got off the phone and I called the guy and I said, what the hell are you talking about? Like, is this your first conference call? I'm like, yeah. He's like, he gave me like all the background terminology of commercial lending discussions. And it does help you quite a bit when you know some of those expressions. It gives you a level of respect in the conference room or call. Another great example is when a residential realtor, I know that they're green, not trying to knock anybody wearing green shirts, when they start telling me they got a cap rate on a 2-family, they need to go away. Okay? It's called a return on investment debt service coverage ratio, cash on cash return, when it's a residential 1 through 4. If you want to try to use fancy words, apply it to the fancy properties. A lender doesn't get overly impressed when you try to use words out of context of the wrong asset type. So learn your terms. And there are some classes with CCAM that actually teaches you terms that apply to commercial lending and commercial real estate. So if anybody is interested, CCAM actually has a basics class. It just got published. They're having it in Pittsburgh for some reason this time. But it's a great class to take. And you learn a lot of the basic fundamentals of commercial real estate and some of the terms. It's just funny when I'm on Clubhouse and I run a club and you got this realtor, I got a cap rate on a 3-unit, and there's like these guys who are just ripping them. Like literally, it's a public flogging of 150 people in the room. Okay, so anybody on Clubhouse? Anybody? So do you know what how a public flogging goes on in a room? It gets pretty ugly. So the poor young lady got like literally booted out of the room. They moved her right down to the audience. It was terrible. I felt bad for her for a minute. Okay? So you don't want to be that person that gets pushed down into the audience in Clubhouse using the wrong terminology. So no questions are bad questions. I want to leave it open to some questions now so we can get some interaction with our panel. We'll start with you, Matt.
Yeah, 2 basic questions about syndication. One, why syndication with the benefits over just taking no corner property? Just why syndication?
This is sure.
And then what are the logistics of syndication? I'm going to put it in terms of single family or small multi, that's how I understand it. But usually you find a deal and then find the financing. Where does the syndication fit in? Do you set up the syndication, find the deal, get the financing?
Why don't we start this way and work our way back?
I'll answer the second question. So I think it's important to have a conversation with someone like Adnan first, right? So you can understand what the process is, what documents you need to get together. You can understand what return profiles you're offering your investors. Get all that sort of ball, and you jump in if you think I'm wrong in the process. But if you get all that ball rolling first, right? But you really need to identify the transaction and get the transaction under contract before you can even legally start Adnan's process. But I would definitely start with at least having a conversation with your securities attorney, because you need to understand return profiles. Like back in Adnan's slide here, he was mentioning preferred return. He was mentioning the waterfall. The sponsor taking 20% after you pay the preferred return. These are all common things, but it's not set in stone, right? You understanding who your investor base is and who you're going out to, whether it's a very sophisticated, I'll use the word sophisticated investor that invests in a lot of deals and knows what a commonplace return should be, or you going out to an investor who is just happy to get a 10% overall IRR. It's a very different thing, and you can structure your offering in that way. So you kind of have to start with that nod and having a conversation and understanding what kind of waterfall you're going to put together, understanding what kind of return profiles you're going to go after, understanding what general terms you need to be offering, and then you go to the property part, and then you go back to adding on. If that makes sense.
Yeah, that's pretty much exactly accurate, right? Obviously, first you want to do your underwriting, but before you go out to a single investor, before you go out to approach anybody, you want to talk to somebody like me, because you might inadvertently start violating securities laws immediately, right? Because some of these regulations allow you to generally advertise and solicit, some of them don't. So depending on your goals, if you've already gone out on Facebook and said, hey, I got this awesome property, I'm about to start raising investments for it, you've already generally solicited and advertised, and now you're locked in to being able to take no non-accredited investors anymore, right? So before you go out to a single investor, you talk to me. But generally speaking, what he said is exactly right. You're going to come and have the first conversation with me after you start to do your underwriting and you know it's a good deal. Then I don't really start the bulk of my work until you go under contract, because on a multifamily deal or any other kind of like commercial real estate, you're going to have 30, 60 days to close, which is more than enough time for me to raise your syndication, structure your syndication, and then for you to go and raise it, right? And you need the money by closing, right? So that's typically the timeline, the way it looks like, but you certainly need to be keeping everybody engaged in the conversation the whole way through.
You also kind of need to know you need to know the return profile you're offering to your investors, so that you know what transactions to go after, and you know how to underwrite them, and you can check the box whether this works or not. You know, a very low cap rate deal that doesn't have a lot of value add to it may not meet the return profile that you're going to offer to your investors. And if you haven't explored that component first, then you're wasting your time underwriting and vetting a deal.
Yes, definitely do your underwriting before you get under contract.
Yeah,
for sure.
Well, and also to comment on your question there, I believe you asked why do the syndication or just get private money. I think that really goes to the deal. Obviously, depending on how much money you're going to raise, if you're going to go raise $10 million, you're probably going to need a syndication. If you're going to go buy, 3 to 6 multifamily, you're not going to need as much money. Maybe you need 2 people to lend you money or 3 people that you know. You can do that through promissory notes, but odds are, if you're raising $10 million, you're going to have more people, and I don't know what the rule is there of how many people you can get before you need to have a syndication, but it's going to depend on the transaction. Yes, you don't need a syndication to go buy it if you have X dollars and you have a couple lenders, or if you want to
The long and the short of it is a syndication, remember, is raising investment dollars. A promissory note is a debt instrument. So you're going under debt, it's going to be secured, right? So if you default on it, it's like any debt instrument, right? You've defaulted on a note. An investment is an investment, it's a risk, anybody could lose their money. But to Ryan's point, again, syndications are not something you see on smaller assets, because you could come up with the cash yourself, or the lender might even finance the whole thing, or whatever it is, right? It really comes into play when you're buying a $10, $20 million, $5 million asset, for which the lender's like, okay, I'll fund you, the 70%, but you got to bring 20 to 30% to the table. Now you got to go find that 20 to 30% cash. That's why you syndicate. That's why you go find that money from investors, right? As opposed to getting all of it levered as debt or all of it from one person.
Also, your investors take on more risk as a sponsor, right? But your investors are also taking on risk. So when you have aberrations in cash flow, up and downs, for example, one quarter maybe you haven't performed as well because your bad debt or your collections were low, or you had some really big expense, or running toilets that you never got to, or whatever it is, your investors ultimately will see a lower return during that period. If you structure that as a debt instrument or a note, there's no forgiveness there.
Yeah.
Whereas your investors share your risk, they also share your reward. You give up a little more because you're letting them share the reward, but they also share your risk. So there's that forgiveness there when you work through some of the operations of cash.
Like the preferred return, right? It's 10% or 6% or whatever it is annually. This year was a bad year. I didn't make that 6%. Your investors have to understand that. If you catch it up the next year, sure. You can't do that with a lender, right? You're going to owe interest every month, although you're in default. Like that's the difference between a debt instrument and an investment.
And I do just want to add one other thing there too, and I encourage everybody to go on our website, scroll down to the bottom. There's 20 ways to fund a deal. IRAs can get, we're not going to go in, they can get loans, non-recourse loans. You can talk to Joe about that on a separate time. But you can also partner them with yourself or with somebody else. You know, for example, a husband and wife might say, all right, well, I'm going to buy this rental property, X% my IRA and X% my wife's IRA, right? Or they might even start IRAs for their kids, and those will be X%. So you don't have to do it all out of one account. And talk to Joe on the non-recourse stuff there. There's some taxes and stuff too, but that's for your other professionals. I can give you more information, but we're not going to go into that today.
Matt, you complete with your question? Good?
Yes.
Anybody else has a question? Oh, go ahead.
Question about I guess your fee is like a certain percentage of the deal size, or you have a range of percentage?
Yeah, sure. So the question was about like fee structuring for legal fees. So most firms will do this. We offer a flat fee on all syndications. On private equity funds, sometimes we might do it as a percentage of the fund, but most of the time it's always going to be a flat fee. Most firms will do that. So for us also, it's a completely flat fee package. And what that flat fee includes is this whole thing, right? I'm going to structure the whole thing. I'm going to form your entities, structure that deal on the corporate side. All your documents, your PPMs, your company agreements, subscription agreements, investor suitability questionnaires, and then of course we handle all your securities compliance, all the filings and everything. We do all of that on a flat fee, all the way through the launch of your offering, right? It's really difficult to give a ballpark on something like that, but it's usually going to be, you know, just to make sure nobody has sticker shock in the room about these things. The fees, the legal fees for structuring your syndication range anywhere on the smaller scale between $10,000 and $20,000, right? But by the way, what you should know about that is legal fees, CPA fees, plumber fees, you know, electrician fees, all of those are expenses of the fund. That's not money that you are expected to pay out of your pocket as a general partner. That is all accounted for in the budget of what you're raising money for, right? So if you're raising, you know, if the purchase price is $1 million, you should really be raising about 1.1 or 1.2, whatever it is, because the total amount you need for the project is what you're raising, right? And again, most law firms will do syndications and private equity funds on a flat fee basis like that. For us, we think it makes it much more of an educational model, and we like that. We encourage people to be able to call us and ask us questions, right? You should feel free to do that and not be like, oh crap, that's 5 more minutes with the attorney. It's another bill, right? For us, it's all flat fee, and frankly speaking, I don't want to keep track of time.
Square too, so he gets charged you right here.
Yeah. Take that.
Piggybacking off the first question about why do syndication too. You know, think about Adnan's fee for a second. It's a flat fee, right? So if you can do a syndication and go out to investors, leverage the ability to raise equity, leverage your debt, and do bigger deals, that's a flat fixed fee, right? So to buy something for $500,000 and go through this whole syndication process probably doesn't make sense. But if you can buy something for $10 million, it really makes sense. I'm using an extreme example. $10 million, it really makes sense. If you buy something for $20 million, it's really his fee and all the other fees, a lot of the other fees, become really less impactful. So you get these big economies of scale as you continue to do bigger deals, and that's one of the other benefits of doing syndication.
You good?
One more question.
All right, does anybody else have a question? We'll come back. We just want to make sure we get. Go ahead.
Yeah, one more question would be commercial brokers. Normally when somebody gives you a phone call, they're going to, I guess, introduce themselves to you and just let you know what their plan is and if they can purchase a commercial or a larger deal. What are those things, and I think you've alluded to them a little bit, but what are those things that you're looking from them to be able to hold conversations you can tell or like discuss this?
Sure. You want to take this one?
Well, we definitely usually ask, and you can you'll probably weigh in more, but for sure, I think they'll want to get a sense of what you own now, and if you don't own something now, and if you're trying to scale, they'll want to know who you're partners with, like the KP or the gray hair guy, whatever. They want to know who your partners are, and I know a lot of people will pair up with these people that have done bigger deals, and maybe you find the deal, and you know a guy who owns 1,000 units, and you go, hey, I found this deal. I want your help, and so we'll want to know about that guy.
And I'm going to put that as part of my write-up from a lending perspective too. That's going to be in my write-up when I'm presenting that to committee for approval.
Right. So experience, right? What's your operating history like? What's your experience? Where's your equity coming from? I always like to know what's your return profile, right? What kind of return profile of a deal are you looking for? You know, if you tell me I need a value add Class B, 100 doors in a B-ish location, but I want to be at a 10 cap, I'm not going to call you back. It just doesn't exist. That product doesn't exist. And if when I can find it, we'll probably buy it ourselves because it's like that deal doesn't happen. So, understanding sort of like where your head is at from a deal profile, understanding that you are sort of in touch with the market, you know what's happening in the markets you want to be in, and that you want to buy something that actually exists in today's market is an important thing too.
We do get a lot of calls like that actually, where you know, someone says I want it, and even today they called and said I want an 8 cap. It's like, okay, where are you getting that?
Yeah.
Well, I want to stress multifamily. Okay.
I mean, how many distressed properties? I mean, listen, maybe in 2 or 3 quarters you're going to see a shift in the market direction.
Yeah.
But you're not. The can has not been kicked far enough
Right.
yet. I think you're going to see the stress fracturing probably second quarter of next year.
So we're in
my
the,
prediction.
I think I agree with that, to be honest.
Yeah.
I think the way it's going.
especially candidly with a lot of the syndications we've been
Yeah.
seeing, honestly. But we are right now, as probably you may know, in a very low cap rate, competitive buying market. So just sort of knowing that before you enter into it, again, it's really dependent on the market you're in and the asset class and the asset type you're buying, but knowing that we're in a very, especially multifamily, we're in a very low cap rate competitive environment is an important thing to know. Talking with your broker and understanding how you can be competitive, important thing to know. We rarely see financing contingencies for people. We almost always see hard money or non-refundable deposits at some point. We more commonly, we were just talking about this recently, more commonly are seeing people put up non-refundable money the day they sign the contract. That never really existed a year ago, 6 months ago.
Yeah.
Like I never saw that, and it's a very common thing right now. So just knowing what's happening in the market and what you can be competitive is important.
A lot of my investors are actually getting out of the northeast region and going to some really peculiar areas right now. I mean, believe it or not, I got a lot of people going up to upstate New York. I'm like, what the hell do you want to do in New York? They're like, New York State is nothing like New York City yet. So the barrier of entry is completely different in Binghamton, Ithaca, Syracuse, Rochester.
We've seen some tertiary stuff
Yeah.
lately.
They stay away from
Colorado.
Idaho.
Yeah.
Anything in Idaho is making money.
So you buy a deal right now, there's a transaction, we did not sell it, but there's a transaction along the main line. It's a great market, 100 plus units, whatever. It's a great value add piece. There's like $200, $300 a month in rent premiums. You know, that trades at 3 cap on actions, right? And it's significant hard money the day you sign the deal. So that deal probably doesn't work. Maybe it works for a syndication, but probably more of like private equity.
Yeah.
It's tough, right? So we're seeing a lot of groups. I don't necessarily agree with all this logic, but we're seeing a lot of groups going in more tertiary markets because they're getting a little bit wider cap rates, better returns. It works a little bit better for syndication, getting careful about the areas you buy in.
Well, this is the next wave. After you see some of the fallout of these poor buying habits that we've experienced over the past 36 months, I think you're going to see repurposing of commercial space going more resi, where it's going to be to eat, work, and live. They're going to keep that 60-40 blend of residential to the retail space commercial. You still can get multifamily financing, 30-year fixed money out there by most of the hedge funds on those type of exit refis. So I'm starting to see more experienced operators looking at mini strip malls, putting 3 floors up in an elevator. It's actually more cost effective for them to do that than build it from ground up and go through all the hairier processes of construction and development. So you're going to start seeing the actual syndication shift a little bit in what type of asset they're going to go after. Last question for Owen.
Yeah, so in there you talk about distribution to your LPs. Who manages that? Like the attorney in your firm, or you have to hire the syndication accountant?
Yeah, so that's what we call a fund administrator or syndication administrator. Oftentimes the GP can handle that themselves, but we don't encourage that all the time. So that's the third piece of it. So in addition to a lawyer and an accountant, you do want somebody who's handling what we call fund administration stuff. What that includes, by the way, on a syndication, you have a couple of things. In addition to managing the distributions and paying out your investors, you need to give quarterly updates, right? So your investors are due quarterly updates, unaudited financials in most cases, but quarterly updates, and then also annual updates, and then things like that, right? So there is investor management that comes along with doing this. You should really think of a syndication as effectively a main fund, right? It's a single project, single purpose fund. It's not a fund that goes out and does investment deals, but you have a lot of the same obligations to investors. You need to keep them updated. You might need to keep them happy. You might get phone calls from time to time, and you need to keep your investor base happy and answer questions and do this and do that. So typically, at least someone on your team needs to be acting as a fund administrator. There are a number of really, really good professional fund administrators that you can hire, but to be honest, they're fairly pricey, and it only makes sense on larger deals. Alternatives to that we highly, highly recommend are platforms. There are a number of really cool software platforms out there. Chief amongst them is one called Syndication Pro. Phenomenal stuff, right? They help you onboard your investors, so you can have everyone e-sign your investor documents that I would prepare for you. They can get their updates directly from there. They can get, you can manage distributions directly from there. So they're really cool software programs that really help you with the admin side of things, and we really encourage, especially first-time syndicators who don't know how to handle those things or have never done them before. Those softwares can make it really, really easy for you to do so.
Okay. So I think we did a very solid 1 hour, 60 minutes of discussion, very engaged. And I see one person blink, said Ed, he fell asleep for a little while. I threw a little water at him, he's awake now, it's good. These gentlemen will stay for a few minutes afterwards. I want to thank everybody for attending this evening. We're going to try to keep the level of discussion every month at a certain level, 102 and above. 101s can go to some of these other events, we're going to keep it 102 and above. Okay? Next month, we're going to talk about structuring LLCs, S Corps, C Corps, or revocable trust. We're bringing in a specialist to discuss that. In November, we're going to talk about the new slice of the real estate industry, which is the wholesale license and a wholesale patent. Because that has to be recognized now, because there's so much off-market real estate. And that's going to start impacting the commercial multifamily space as well. Some of these individuals are just falling on deals and they don't know what they have. So it's going to be very interesting. We're going to bring some more professional wholesaling, and we're going to bring a licensed expediter in also. That's in November to talk about the wholesale license and what that looks like, not just for Philadelphia, where it's going national, but it's already in Chicago as well, and some of the other cities that are out there. And then December, it's going to be tax talk. We're going to bring a CPA specialist related to real estate investment. And that might be earlier in the month. It'll be probably the first Wednesday in December. But we're pretty booked out here for the rest of the year. We're going to have that mentoring, masterminding discussion every first Monday at Moonshine Philly. So it'll be a little more cash, a little more discussion. We're trying to really help you, direct you with the right people, building up your power team, hopefully helping out with some direction and some strategy in real estate. And I want to thank our panelists. I want to thank Gary Dell for filming this. This is live. We'll have a tape recorder. It'll be on our YouTube channel on Real Estate Niches and podcast. So you can find all this on there. It'll be taped and edited. And again, I want to thank everybody for coming out. And we'll see you again next month, or we'll see you at the Mastermind event. Michelle, I want to stick around for a little bit. Everybody have a great night.